So I'm going to share with you today a couple of the trends that we've seen in the mutual fund industry that will affect the front office, the back office, and some of the major shifts that we've seen in 2011 and then going out into 2012 and forward. And I limit it to 5. We'll start with the asset side. When you look at the assets in this industry, we have about 30 trillion in assets. And the industry is still an equity industry. So we have about 43% in equity assets. While equity has had some trouble in the last couple of years, it remains the main driver of this industry. However, you also now have about 9 or 10% in mixed assets, and that goes in the direction of investment solutions. So there are more investment solutions being packaged from an asset class perspective. Of course, fixed income with about 20% or so has been the main recipient of flows in the last few years, and how that will be structured going forward. If you look at the US debt situation, the European debt crisis, and just in general, the high yield appeal and emerging market appeal vis-a-vis developed countries, how these bond and equity packages are being put together is very important for the industry. The last trend from an asset perspective that we've seen is the rise of alternatives. So they now are roughly 8-9% of the assets worldwide in this $30 trillion industry. And that is good for the industry because it's fusing the traditional asset management space with the alternative space. But at the same time, it also brings up some concerns, which institutions or retail investors should be exposed to alternative investments, and then how do you package alternative investments for a retail investor in a wrapper and the like. So you end up with an equity-centric industry still today, with over 50% if you combine the mixed and the equity funds in those kind of asset classes. And then the question of how you tie in bond funds, which have seen many great products and a lot of flows in recent years since the crisis, and the rise of alternatives. So that's a framework from an asset perspective. And the blurry lines of demarcation here from an asset perspective are what we have seen. Now that has resulted in 3 or 4 main trends. First, from a flow perspective, you had ups and downs in the last couple of years that impacted both regions as well as asset classes. So we've seen pre-2007 monstrous flows going to equities. Since then, much more going to fixed income, global fixed income, and high yield. And also the rise of alternatives, ETFs in terms of flows, and now this investment solution type. Now, the alarming factor is that in 2011, for the first time, you only had 200 billion in long-term cash flows around the world. That's still a lot, but it's down from 1 trillion. So it's only about 1/5 of the flows that we've seen in 2010 and in 2009. So when you talk about 1 trillion before, there was a lot more money to go around. Now it has only been 200 billion last year, and that shows the anxiety in the market around debt, etc., around the shifts between emerging and developed markets. Now the flows have gone more to emerging markets, and we basically see this line of demarcation on the investment side. So more investments into emerging market equity, global equities, emerging market fixed income, but also more power on the distribution side. So Brazilian firms like Jakob Safra is buying a bank in Switzerland with Saracen. Also, Bank of China is buying in Switzerland or is going into Brazil. So you see more a competitive landscape between the emerging market space and the developed space, meaning that in the past, we've seen American firms and European firms go into these high growth markets. Now you see the reversal. So there's some emerging market managers and firms that are now buying US managers, they're buying European managers, and they're going to compete with them. So that's another big shift. The 2 other factors that we have really seen change the industry is you have the lower set of flows, but what is more remarkable is that we call what we call a blockbuster phenomenon. And that combines with another one that's called David and Goliath. So blockbuster phenomenon is the following. Last year and in the last couple of years, about 100% of all cash flows went to only 0.3% of the products. So if you look in the past, it's always been a concentration around the top 1% of products, but then has come down to 0.5%. Now it's less than 0.3% that get the equivalent of 100% of cash flows, which is similar to, let's say an Apple or Microsoft or Google in specific industries, or Facebook. The the big bulk of the money goes to very few providers and very few products, blockbuster products. And we've seen that money go to David firms and Goliath firms. So boutique firms that are very good at what they do, alternative fund managers or big fund managers like Franklin Templeton and PIMCO and Fidelity and others, they have benefited from that. Which means success can be stellar if you have a blockbuster, but it can also mean you get nothing if you're not rising to that 1% or less than 1%. So if you think of it in a summary, we have in this industry today a couple of big shifts. We have a very large industry that's growing fast because of the retirement needs, because of the investment needs of a growing middle class. We have an equity-centric culture, but there are more investment solution products that are being built. Fixed income is a question mark going forward, and alternatives have to be tied into this from a regulatory and product perspective. And then we have, from a cash flow perspective, less flows, but more concentrated flows to fewer managers and fewer product. And then last but not least, the emerging and developed regions and products are competing with each other more than ever. So it's an exciting landscape. It's a great industry. It's a fast-growing industry, but it has become much more complex. And we look forward to 2012 and see how this all resolves.